All right, hi everyone. Welcome to today's webinar brought to you by Vantage. With today's topic is going to be on President Donald Trump's second coming in the White House. Right, just want to let you all know we're streaming directly into the Vantage app as well as over Zoom. So do not hesitate to drop your questions in the relevant chat boxes as we progress through today's webinar. All right, I think we're all good to go. All right, before we begin, right, please take note of the disclaimer. The information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage and are solely used for educational purposes as they do not constitute investment advice and or consultation on how a client should trade. Also take note of the risk warning that comes with trading margin forex and CFDs as they carry significant risk and is not suitable for all investors. Right. My name is Ketan Ramachandra, and this webinar series is brought to you in a special partnership between Vantage and Everest Fortune Group, where we've been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right. So, as we all know, right, Donald Trump was sworn into the White House for his second presidential term on 20th of January. And before that, the US elections took place on 6th of November. Now, since his swearing in ceremony, right? Trump has signed off on numerous executive orders, and we'll take a look at some of those orders that are more relevant or would have a more direct impact on the financial markets. And we can see, and we'll take a look at what are other policy changes that we can expect. And also, right, if you've been tracking the news, right, you can see that over the last couple of weeks, Trump has also been imposing trade tariffs on some of the US major the United States' major trading partners such as Canada, Mexico, and China, and eventually he'll take his aim at the EU as well. So all these actions by him have created have injected a lot of volatility into financial markets over the last 10 days. Right. So let's take a quick timeline of Trump's second presidential term. Right. So basically, right, Republican nominee, right, Donald Trump won the US elections on 6th of November last year, and the inauguration took place in January on the 20th. Now, during in leading up to the elections as well, not only the inauguration, but also leading up to the elections, there was a lot of uh, interest on Trump trades, which focus on sectors such as energy, financial, and industrial, and these sectors had rallied strongly following the election results. Now we'll take a look as what has happened to the Trump trades, so to speak. Has the momentum continued as he came into office, right, or has the momentum faded? Right. So we'll take a look at these three sectors, and also we'll take a look at how uh, the broader financial markets have also been responding since. Right, especially with the ongoing uh, trade tariffs, right, imposition of trade tariffs by the US on its trading partners, and also suspensions as well. So not only has Trump announced trade tariffs, he has also walked back on certain tariffs, right, giving the other countries about a 30-day suspension, for example, to renegotiate new terms. So that's all created a lot of volatility and wild swings in the market as well. All right, so let's have a summary. Let's take a look at the summary of the Trump trades, right? Basically, they focused on the three sectors. The three sectors were energy, financials, and industrial. Right, so Trump is in favor, right? With regards to the energy sector, Trump is in favor of eliminating investments and tax breaks for renewals and focusing his attention on the oil and gas firms, right? So he's looking for faster permits, looser environmental regulations, and extension of tax benefits for these oil and gas players. Now, for the financial sector, right, Trump, looking at his first presidential term, he has always been in favor of deregulating the industry. So once again, we can expect further cutting of financial industry regulation, and also he's also very pro crypto, right? So we can also expect uh, this administration to be more favorable towards cryptocurrencies, right? But specifically for Bitcoin. And for the industrial sector, right, his made in USA policies are likely to benefit domestic SMEs, right? Especially with the tariffs imposed on imports into the country, right? The focus is going to be on SMEs that could potentially benefit from made in USA policies, right? Especially now over the last seven trading days or so, right? We've seen tariffs being imposed on countries such as China, Canada, and Mexico, and eventually the EU will come in the spotlight as well. Right now, Trump has signed off on a huge barrage of executive orders, right? He didn't waste time. As soon as he was sworn into office on 20th of January, he signed off on a barrage of executive orders, right? Of course, not every executive order is focused or would have a direct impact on financial markets, but let's take a look at some of those that may have a more bigger role to play. Now, some these are this is not an exhaustive list. This is just uh, a handful of executive orders that pertain more to the financial markets and could influence the environment as well, the financial environment. Now, one of those executive orders that he signed off was implementing a regulatory freeze to halt new regulations. Right now, as we all know, President Donald Trump has been in favor of deregulating many industries. So this is one way as well by freezing any new regulations, right? Even without doing any deregulation, putting a freeze to any new regulations in itself is sort of like uh, deregulating as well, right? So this could be positive for economic growth, right? His main idea behind deregulating many industries, right, is to promote or to stimulate economic growth. Now, he has also signed off on an order where the US has withdrawn from the Paris Climate Agreement, right, because they do not want to be held to the credit, carbon credits program and things like that, right? And they want to be, and he wants to make the US energy independent, right? So by withdrawing from the Paris Climate Agreement, right, the US is free to make its decision on oil and gas production and does not need to adhere to any other uh, regulatory needs imposed by the Paris Climate Agreement. Right. He's also founded the Department of Government Efficiency, otherwise known as DOGE, right? Improving government efficiency, right, is going to help the economy as well, right? As we all know, the US debt to GDP ratio is pretty high. I think it currently stands at about 120, 130% of total GDP, which is a very high figure. And by improving government efficiency and removing government bloatedness, right, he's going to help make the government more efficient, and of course that is going to have a good knock-on effect on the greater economy as well. Now, he has also rolled back the previous president Joe Biden's policy on artificial intelligence and has issued a new order that is focused on promoting growth for this sector as well. So primary beneficiaries would be companies from involved in the semiconductor sector, data centers, and utilities. And the last one, right, he declared a so-called national emergency to reduce bureaucracy and allow more drilling, right, in the US. So this is regards to oil and gas production. This is in a bid to expand supply, expand production, and increase the supply so that he can keep energy prices lower. By keeping energy prices lower, right, this is going to have uh, negative impact on high inflation, right? Is going to have a dampening impact on inflation, right? As we keep energy prices stable and make them uh, move lower, right? Keeping it under control and keeping them maybe moving a little bit lower, right? It will help overall inflation in the US. Now, what are the impact on financial markets, right? So for the energy trades, let's take a look at some of the energy trades, right? So uh, with before this we're going to be comparing it, we're going to compare the Trump trades as how they perform leading into the elections, as well as and then seeing how they performed once he came into office, right? As we look through the charts later, we'll see that it's pretty much been a tale of two stories, right? So energy sectors, in the energy trades, right, you can trade the ETFs, right? One of the most popular energy ETF is the SPDR Energy Select ETF. The ticker symbol is XLE. You also have a more specific ETF within the energy sector. This is focusing on oil and gas equipment services, and you have another Fidelity MSI Energy Index as well. And of course, some of the biggest oil and gas companies in the world are ExxonMobil, Chevron Corporation, ConocoPhillips, Baker Hughes, and Noble Corporation. right? So we'll take a look at some of these ETFs and a couple of these ETFs and a couple of the stocks to see how they've performed going into the U.S. elections, and also as Donald Trump came into was sworn into the White House. Now, on this chart, right, we have the ETFs. On this page, we have the ETFs, the charts for the ETFs, XLE and XES, right? Basically, the whole energy select ETF and the oil and gas equipment services. Now we can see there's two vertical lines on each chart. The first one is on 6th of November. This was when the elections were held in the US. And you can see for both charts, right, these ETFs are gapped higher on the day itself, right, on 6th of November as markets open, right? We can see these ETFs and gap significantly higher, right? XLE, for example, closed at around $90 the day before Tuesday, and it gapped higher to open at about $93. Similarly, for the XCS as well, it closed at around just above $78 on 5th of November, and it gapped higher at around $82 following the election results. So you can see his election win had boosted a lot of the many of the Trump trades, right? And then we can see that in the share price action as well. Prices continue to rise, especially for the XLE, till till the end of November before finally running out of steam. Right. Similarly for the XES as well, it pulled back a little bit, but managed to make a new high in November and December before pulling back as well. So you can see here the Trump trades were significantly boosted as he won the elections. However, since then, it's been a pretty volatile ride as well. And as uh, his inauguration date loomed closer, right, you could see prices for these respective ETFs move higher as well, right? So once again, they were uh, bid very strongly leading into his inauguration, but after that they sold off quite sharply. Right, looking at the biggest two of the biggest oil and gas players, right? Or well, looking at ExxonMobil, sorry, and crude oil futures. Once again, you can see, right, ExxonMobil actually uh, got a good boost following the results of the election. However, after that, we can see the share price of this company pulling back very sharply, right? Dropping down probably to a 2024 low. And then it's managed to stabilize and rise quite sharply, rebounding quite steadily going into the inauguration. But once again, as soon as he was sworn into the White House, we can see the prices for ExxonMobil dip back. However, we can see that earnings results were also released for ExxonMobil last week, right? I believe this should be last week. And the earnings results were pretty strong. And we saw a nice fundamental catalyst for ExxonMobil. So you can see here how the hype of the elections, right, boosted the share prices of many oil and gas ETFs, oil and gas share prices of oil and gas companies as well. But after the hype had sort of worn out, you can see fundamentals taking over, and the share prices of the respective ETFs and ExxonMobil, for example, pulled back quite drastically. Right. And then the inauguration, right? The inauguration, as markets headed into the inauguration date, inch closer towards inauguration date, you could see some hype building up once more and pushing prices higher. But for now, right, in the current context, right, it's good earnings that have boosted the share price of ExxonMobil. So basically, right, don't get carried away by the narratives, right? The narratives such as U.S. elections and Trump's inauguration, right? Of course, there's a genuine reason for share prices to of these companies and ETFs to appreciate, of course. But then again, right, it's actually what at the end of the day, it all boils down to the fundamentals of that company and the environment for that sector as well, right? How all that is going to play a part. Even for crude oil prices, right? You can see crude oil prices rising into the US elections. But of course, crude oil prices, of course, is going to be has other many other moving parts, right? You have to also have to look at global oil production and supply levels, global demand, and many other factors as well. But you can see as oil prices significantly were negatively impacted as President Donald Trump announced his executive order to expand oil and gas production in the US. So as production is increased in the US, we can definitely expect more supply to come into the market, and that's going to have a negative impact on oil prices, which we've seen right since 20th of January. Right, we've seen prices. We've seen crude oil prices hit about $81 per barrel just before his inauguration, and since then have dropped as low as $70 per barrel last week. Right, so you can see here how expanding oil and gas production in the US is likely to drive crude prices lower. Not only crude oil prices lower, but also natural gas prices lower. Right, and that's in a bid to keep energy costs low, and of course that is going to lead to lower inflation over the longer term as well. Right. Now let's take a look at some of the financial trades, right? Remember, Trump is in favor of deregulation, right? He has previously deregulated the financial industry in his first presidential term. As of now, there's no uh, major news or no concrete news of what he may do with regards to this sector. But we all know he's been very pro cryptocurrency as well, particularly Bitcoin. Right, so let's take a look at the ETFs first, right? The SPDR Financial Select ETF is the ticker symbol is XLE. And then we'll also take a look at JP Morgan. JP Morgan is the biggest bank in America, right? So you can see here, going into the elections, right? XLE was trading at around 46.50, $46.50. But as soon as the election results were confirmed and confirming Donald Trump's victory, we can see this ETF gap significantly higher, making a new high at about $51.40 in early December before pulling back quite sharply, right? And then as inauguration date inch closer, we can see that prices for this ETF started to climb as well and has moved higher following the inauguration. Now, the reason for the XLF ETF to move higher is because we had earnings seasons taking place at the end of January, early February this year, right? So, and most of the major banks in the US have posted better than expected earnings results. So, there's a strong fundamental catalyst behind behind the financial sector. All right, hi Shirko. If there's time, we may touch on gold, right? We're going to be focusing on the Trump trades for now, right? And it is also while the ongoing trade tariffs have also uh, triggered strong demand for gold. So yes, I will be able to cover gold as well. And something is moving right. Okay, because and you're talking about negative correlation with gold. Typically, gold gold prices has a negative correlation with the US dollar. So that means if the US dollar is rising, gold prices are expected to fall. And if the US dollar is falling, gold prices are expected to rise. But take note, this is not negative correlation that lasts forever, right? There are times where this negative correlation breaks down due to changes in the macroeconomic environment. And there are many cases that we've seen over the course of last year and this year as well, where there's actually positive correlation between the dollar and gold prices. So that is why we see them moving in the right direction. All right. Okay. So we'll touch on gold as well later on. Okay, so back to the financial sector, right? So we've seen, for example, JP Morgan announce its earnings in the third week of January, along with many of the other major banks, right? Citibank, Goldman Sachs, uh, Morgan Stanley, so on and so forth. So in general, um, the financial sector or the major banks in the financial sector have posted better than expected results, right? Earnings results. That is, hence, there's a strong fundamental catalyst for the share price to rise higher. So, right, once again, it all boils down to the fundamentals of that company, fundamentals of the sector, right? And of course, if there is an external catalyst, such as Trump's inauguration or the elections, right, this definitely can help prices climb higher. But of course, at the end of the day, everything's pretty much is going to boil down to the fundamentals of that sector and of that particular company. Right. So you can see here a big distinct uh, bis- distinct price action between the energy and financial sector, right? You can see financials have the share prices of the financial ETFs and the banks have outperformed the energy sector so far. Right, and also finally coming down to Bitcoin, right, with President Donald Trump and his administration being very pro Bitcoin, we can see Bitcoin prices uh, uh, climbing or surging higher as the election results were confirmed. Now on the left, I have the chart for IBIT ETF. This is the uh, ETF, Bitcoin ETF by BlackRock, I believe, if I'm not mistaken. Yes, the Bitcoin ETF by BlackRock. So take note, this doesn't trade 24/7. It's an ETF. It trades during the regular US trading hours, right? And it also doesn't trade over the weekend. Whereas Bitcoin, of course, trades 24/7, and hence you don't see the gaps on the chart for Bitcoin prices as you would see on the respective ETFs, not only IBIT, but any other ETF that tracks Bitcoin or any of the other cryptocurrencies, right? You would typically see a gap like this, especially over the weekends. Now, of course, we can see, right, election results were confirmed on 6th of November. We see this ETF gapping higher naturally, of course, with Bitcoin surging from about $66,000 prior to the election and rising as high as 80,000 in a matter of days. And of course, breaking above 105,000 by the end of 2024. So you can see Bitcoin, right, coming out of the elections, right, has been marching higher, right, a very strong rally. But since mid-December, Bitcoin pulled back. However, as Trump's inauguration was inching closer, right? His inauguration date was inching closer. We saw a strong bid in Bitcoin once again, almost surpassing the price. Yes, it did surpass the prior high, right? It made back then in mid-December an intraday all-time high close to about 107,000, I believe. And then following the inauguration, right, we see Bitcoin registering a new all-time high as well. But since then, prices have pulled back. However, you can see on today's chart, right? Or yeah, this chart was pulled off earlier today. You can see prices have stabilized at above $96,000 and looks to be moving higher. So you can see the Trump's the U.S. election results, right, and Trump's inauguration have really functioned as strong catalysts for Bitcoin. And now, finally, coming back to the wrapping up with the industrial trades, right, with potential made in USA policies being implemented and the imposition of trade tariffs on global trading partners. Uh, Domestic companies are likely to benefit, right? Especially if certain policies or executive orders get pushed out. So do take note, any executive orders signed off by Donald Trump with regards to the domestic manufacturing and industrial base is likely to have a pretty strong impact as well. But again, right, this impact may not be might be short-lived, right? Especially if there's no real fundamental story to it, right? If the companies are not getting the contracts or they're not delivering, right, and they are not having new projects, then naturally, right, their earnings are not going to improve, right? You are looking for earnings growth, revenue growth, and if you can see that translate at a fundamental level, then of course, quite likely, like the iShares Russell 2000 ETF is a small and mid cap ETF. Is likely to benefit. The companies within this ETF are likely to benefit, as well as other domestic manufacturing and industrial players in the US. Now, just taking a quick look at the IWM ETF, right? The IWM ETF is the ticker symbol for the iShares Russell 2000, right? It's a small and mid cap ETF. It's an ETF that tracks the small and mid cap companies in the US. And then we have one of uh, the domestic players as well, right? Applied Industrial Technologies. So you can see very clearly as the US election results are confirmed, both the IWM ETF, right, the Russell 2000 ETF, and the share price of Applied Industrial Technologies gap significantly higher, right? Gap significantly higher, continue to climb higher as well, continue to move higher for AIT. But IWM, you can see Russell 2000 pulled back sharply. They was trying to close the gap, but reverse higher by December. But then since then, you can see the hype of the US elections and inaugurations has died off, right? In fact, Trump's inauguration did help a little bit. You could see the IWM being bid up quite strongly. And the share price of AIT as well. But since then, you can see the share price has gone nowhere, sort of trading sideways. So once again, you can see very clearly here how hype around the election results and hype leading into the inauguration can help boost the share prices of the ETF and the AIT. But take note, right? Ultimately, it's all about fundamentals as well, right? So do look out for any upcoming executive orders that are going to be released or but signed off by Donald Trump, right? If you see any specific orders aimed at boosting the industrial and manufacturing companies, right? The domestic companies is likely to see a very nice short-term lift or bullish catalyst for this ETF, right? The Russell 2000 ETF, IWM, as well as other small and mid-cap players. All right. Now with that, let's move on over to the chart and trading view, right? Since there's a question on gold as well, right? So let's move on over to the charts and trading view. Right, and we're going to compare this. Okay, so once again, before we start, I'm on a daily time frame here for the dollar index, right? Daily time frame, and we're going to compare it with the price of spot gold. We're going to compare it with spot gold. Right, so the candles on this chart are represent the dollar index, and the maroon. Let's just switch this line. Can I change this line? Let me see if I can change the line. Let's change it to gold so that we know that this is, of course, the line that tracks gold prices. Now, typically, uh, the value of the US dollar and gold prices share an inverse relationship, or what is also known as negative correlation, right? Or inverse correlation. So that means as the value of the US dollar is falling, as represented by the dollar index, where the dollar index is a basket of, is an index that measures the strength of the US dollar versus a basket of currencies, right? And in that basket, we have about, that basket is made up of 60% euro, about no sorry about 55 or 60% euro, about 15% Japanese yen, and then the remainder is made up of currencies by the Swiss franc, British pound, and the Swedish krona, if I'm not mistaken. But the bulk of the basket is denominated by the euro and the Japanese yen, making up almost 70%. So it measures the strength of the US dollar versus its peers that comprise that basket. So as the value of the dollar index is falling, as what we see here at the end of June, from about 106 to around 100, right? Typically, when we see the value of the dollar falling, typically it's going to function as a, a bullish catalyst for gold prices. So we can see very clearly gold prices, value of the US dollar falling, gold prices stabilizing around $2,300 per ounce and moving up very nicely. But we can see here, right, during this period, here, which is from 26th of June till about 27th of September, right? During this period here, we see a very strong negative correlation, right? So we see value of the US dollar falling, we see gold prices rising, right? This is the negative correlation that these two asset classes typically share. However, now we can see something very different take place between 27th of September till 5th of November. During this period, not only did gold prices continue to climb higher, we also saw the value of the US dollar climb higher as well. So you can see here over this period, there's a breakdown in the negative correlation. And in fact, the negative correlation has turned positive. So value of the dollar is rising, value of gold prices are rising as well, right? So part of this is also due to uncertainty as well, right? Remember 6th November, let me just move this to 6th November. 6th November was also when the US elections took place and the results were confirmed. And gold prices continue to lead higher going into the election due to potential uncertainty, right? There could have been a lot of uncertainty following the results of the elections, right? Especially if it was a close call between Trump and Harris, right? Between Kamala Harris and Donald Trump. If the results were very tight, right? They would have created a lot of uncertainty and they would have part of the reason for gold prices to march strongly higher. And also dollar was rising higher over this period because we saw macroeconomic data improve in the US, right? We saw non-farm payrolls rebound in October, November. We also saw inflation picking up, right? Headline CPI accelerating over this period, which is the last quarter of 2024. So over this, between this period of 27 September and 6 November, gold prices were rising as we headed into the US elections, uh, raised by uncertainty if should there be a dispute on the outcome of the election. And at the same time, over this period, macroeconomic data in the US was improving. We saw a rebound in non-farm payrolls. We saw a rebound in employment growth as reported by the ADP. And at the same time, we also saw headline consumer inflation accelerate in the US. So inflationary pressures increasing, job growth rebounding, functioning as strong bullish catalyst for the dollar, and elections uncertainty pushing up gold prices as well. You can see initially as the dollar index rose higher until the second week of October, gold prices actually pulled back a bit, but then after that they reversed to follow suit with the direction of uh, the value of the dollar index. So over here, you can see how the macroeconomic environment changed. And also between 26th of June and 27th of September, during this period here, highlighted by the box, during this period, we actually saw inflation moderate lower, right? Inflationary pressures were dissipating in the US. Job growth was also softer than expected, right? So monthly job growth as reported by non-farm payrolls and the ADP showed slower job creation combined with inflationary pressures dissipating and looking forward to the first rate cut that took place on 18 September. So during this period here, there was a lot of factors that were driving the value of the US dollar down, which in turn were pushing gold prices up, as typically these two asset classes share an inverse relationship. Now you can see here between uh, end of September and first week of November, that inverse relationship breaking down, and we saw positive correlation. Even now, we are seeing mostly positive correlation between gold and the value of the US dollar, right? Dollar index rising higher from first week of December, second week of December. And at the same time, we see gold prices, after pulling back slightly, moving higher once again, right? So you can see there is a lot of disconnect, or not disconnect, but I would say the negative correlation between the value of the US dollar and gold prices that many are used to, right, have now actually broken down quite significantly uh, since 2022, 2023. So we are seeing more periods of positive correlation between the US dollar and gold prices. So this is a good lesson, right? Just because in the past, right, the value of the dollar and gold prices shared a very strong inverse correlationship. It doesn't mean it's always going to last forever. And there are periods due to different macroeconomic conditions, right, or altering landscape, right, altering economic landscapes that can cause the negative correlation to break down. And we can also see periods of very strong positive correlation. So don't be fooled by the fact that if you see the value of the US dollar rising very strongly, we can expect gold prices to fall. Remember, now over the last couple of years, I've seen, and many other traders have seen the positive correlation between these two asset classes grow stronger and is occurring more frequently than it had in the past. So do take note of that. All right, okay. So before we continue, maybe since we're talking on gold and dollar index, perhaps we can do some technical analysis on these two asset classes, right? So let's start with um, the dollar, right? Okay, let's start with the dollar. Okay, maybe let's just move back and see where else in period where we can see the positive correlation very strongly, right? For example, here at the end of December, or in December 2023 till the end of April 2024, right? The value of the dollar index was rising higher generally, right? And at the same time, we can also see gold prices following in tandem, right? So the very strong positive correlation over this period. Now over here, right, between July 2023 and October 2023, we saw the value of the dollar index rise sharply. And over this period, we actually saw gold prices drop lower, right? Although there were strong retracements to the upside, but generally you can see between July and October 2023, there was negative correlation between these two asset classes. Even here, right, from May 2023 till June 2023, value of the dollar index was rising, gold prices were pulling back, negative correlation, right? Even here, right, since October 2022, value of the dollar index falling sharply, gold prices moving in the opposite direction. So you can see uh, the negative correlation holds true for most periods of time, but we can also see when that correlation breaks down, right? Even here, right, since August 2021 till March 2022, we can see that there's generally more positive correlation between these two asset classes rather than negative. So be aware that the negative correlation can break down, and we started to see more positive correlation take place between the US dollar and gold prices, right? This can be due to safe demand for safe haven assets, right? Safe haven assets are typically gold, US treasuries, and the US dollar itself. So during periods of high uncertainty or geopolitical crisis or, or heightened geopolitical tensions, we can see strong demand for the US dollar and strong demand for gold, pushing up both of these asset classes together, right? Okay, so with that, let me tidy everything up here. All right, so with that, let's start the analysis on the dollar index and establish where the key support and resistance levels, right? This is very useful, right? Exactly with what uh, we are seeing as well, right? With gold being bid up higher now by trade tariffs, right? Uh, Rising concerns on global trade tariffs have increased demand for gold. And at the same time, it's going to be interesting as to see how the dollar is going to move as well over the next few days. All right. Okay. Right, Sherko. With regards to gold, right, we can see, right, I just have what I'm going to do now, right? We're going to start the analysis, right? Let's start with the dollar first, sorry, right? So we can see, right, in the background, I have the Ichimoku cloud. The Ichimoku cloud is a momentum indicator. And when it's green in color, it highlights bullish momentum, especially when the price of that asset or that instrument is trading above the green Ichimoku cloud. So when you see the price of a particular instrument rise higher and it trades above the green Ichimoku cloud, it highlights strong bearish momentum. And at the same time, when the price of the instrument is trading below the red Ichimoku cloud and both of them are heading lower, it highlights strong bearish momentum. And the crossover points also indicate a potential shift in momentum, right? Over here, we see the dollar index breaking above the red Ichimoku cloud. And at the same time, but before that, we also see the dollar index breaking out of a descending trend line, right? So you can see the first bullish breakout takes place through the descending trend line, then prices rises strongly, and the dollar index also makes a crossover through the bearish Ichimoku cloud, giving us further conviction that there's a very strong, there's a potential for a very strong bullish move to the upside, which is what played out nicely. For now, right, the green Ichimoku cloud can function as an area of support, which is what has happened on Monday, 27th of Jan, and it's something that has happened in the first week of February as well. So you can see the cloud itself can function as a nice area of support. Now with that, right, uh, last week non-farm payrolls was actually weak, right? Non-farm payrolls came in softer than expected, but the unemployment rate edged lower, right? So it was a mixed result combined with the ongoing trade tariffs, right? It's creating a lot of uncertainty for the dollar index. However, right, if the dollar index can stabilize around, actually, it did stabilize at this overlap level, right? There's a nice overlap level at 107.49. Identify this as the first support, right? We can see here the dollar index stabilizing on Friday, 24th of Jan, then bouncing off on 30th of Jan, and then again on the 5th of February. And previously, it functioned as a swing high resistance at the end of November 2024. So this creates a nice overlap, which we can identify as the first support. And we can see last week, the dollar index stabilizing of the support and staging a pretty nice rebound. So we've seen a nice bullish bounce materialize, and we see the nice bullish bounce materialize. And quite likely, the dollar index should finish higher on the week, right? On the weekly chart, right? It actually closed in the red last week. It's green uh this week so far, but I think it's we could see demand for the dollar remain strong as we wrap up this week, and it's quite likely we are going to see dollar index probably push a little bit higher. Now, in terms of resistance, right? The first major resistance, of course, is going to be this swing high here that has taken place on in mid-Jan at 109.64. So this is where the first resistance sits. Now, on this downtrend here, we can also run a Fibonacci retracement starting from this swing high, 3rd of February, down to this swing low on the 5th. Looking at where the 61.8% retracement sits, there's a pretty decent pullback resistance that I would like to highlight as well, right? So we can highlight this as an intermediate resistance, right? So you can see there's a pullback resistance here in line with the 61.8% retracement. So this is also another resistance barrier as well. So that means should we see the dollar index climb higher, right, we can identify this pullback resistance as a potential take profit target, and perhaps the first take profit target for the dollar index can be identified at around the 61.8% Fibonacci retracement. So that's at 108.95. And of course, if this index continues to climb higher, we'll be targeting the first resistance, which is at 109.64 as the next potential take profit target. Now, beyond the first support, right, there's a pretty uh, strong overlap as well at around 106.13. This is where I would identify the second support. Right, we can see a prior swing high resistance functioning as support in mid-November. And then again at the end of November. Of course, we can see the price cutting below it, right? The index falling below this level. But generally, this is a pretty significant overlap at 106.13, which I will identify as the second support. Now, on this uptrend here, we can run a Fibonacci retracement from this swing low on 27th of September, going up to the swing high on the 13th of Jan, looking at all the fibs. We can see that 38.2% sits quite close to the overlap. So let's keep 38.2% in the analysis. And of course, 23.6% can no longer be used because price has cleanly broken below it. So we're just going to keep 38.2% here. Right. So we've seen demand for the dollar pick up at the end of last week, right? Specifically from Thursday onwards. And we saw this rebound continue yesterday as well, Monday, 10th of February. Today it looks to be a little bit down, right? Pulling back a little bit. But I think generally we should see the dollar index close higher this week, right? And it's perhaps if we can reach the 61.8% Fibonacci retracement, right? The pullback resistance at 108.95. This is where I would identify a nice, a suitable take profit target for any long trades that we may have for the dollar index. Now, coming back to gold, right now, not coming back. Now let's switch over to gold. Right, we can see here, gold has made, this is spot gold, XAU USD has made its latest intraday high today, right? And this is at $2,942 per ounce. The latest intraday high was here. And the prior intraday high was formed on 31st of October, and that was 2,794. Now, a swing high resistance like this is important, right? A swing high resistance such as this is important. This swing high took place on 31st of October. Why is it important? Because we can see as price rose higher at the end of January, we can see gold prices stalling close to the prior high, pulling back before finally making a strong bullish break right at the end of January. So we can see once the bullish breakout takes place, right? Once the bullish breakout takes place, what was a previous swing high resistance can be a potential support level, right? So we're going to be keeping a close eye for levels that get broken as well, because a prior significant swing high resistance, such as this one here that occurred on 31st of October, can now be a potential support area. For now, let's label it as the first support, but there's something in between that we can highlight. And of course, the first resistance, okay, I'll come back to where the first resistance is going to be, but first support is clearly here. And of course, with this nice uptrend, we can also run a Fibonacci retracement starting from this swing low, 18th of December, going up to the swing high of today. When I look at all the fibs, right, we can see 38.2% sit just above the first support. So let's keep that on. And below, right, actually see a nice overlap, right? This was a support on 23rd of October, and then resistance on 8th of November, resistance on 25th of November, resistance on 12th of December, then resistance again on 16th of Jan. You can see here, this is previously a very strong overlap resistance. And once the bullish breakout took place, this prior overlap resistance can now be an overlap support. So second support is at $2,750 per ounce and is also accompanied by Fibonacci retracement at 61.8%. So we'll keep 38 and 61 in the analysis. Okay, in terms of resistance, right, we don't have any other prior swing highs or pullbacks that we can reference. In such a scenario, we're going to rely on Fibonacci tools such as extensions and projections. I'm going to run a retracement here. The purpose of this retracement on this downtrend is to find extension levels, which sit at 137 and 161%. And we can see here on the daily extension, the gold prices has stalled pretty much at exactly the 161.8% extension. So that means as gold prices were rising, right, we had identified key extension levels at 137 and 161%. So as the bullish breakout took place here in the first week of February, I would have used the first extension level at 137% as a potential take profit target because we can see prices consolidating around this level here for a period of 2 or 3 days, prices consolidating here before finally moving higher. And as it broke higher, right, we would have used the extension at 161% to identify the next potential take profit target, which is where gold prices look to have tapped out today, right? It's run out of steam pretty much at exactly $2,946 per ounce. Right, when we go down to the 4-hour time frame, we'll be able to see this a little bit more clearer, right? And we can also now identify, of course, the first resistance at the latest intraday all-time high, which is also where the 161.8% Fibonacci extension sits. Okay, so these are the key levels here. So with gold pulling back, right, this might present itself as a buying opportunity, right? So also let's take a look at where the 23.6% retracement sits. Right, 33.6% retracement sits at this consolidation level here. So this could be a potential pullback level, right? And because you can see price uh, running the resistance on 5th and 6th of February. This prior resistance can be a pullback support level, right? So in this case here, I'm just going to fine tune the levels. First support is the pullback at 2,867, accompanied by Fibonacci increase by 33.6%. And the overlap at 2,787 is going to be my second support. And of course, this other overlap at the 61.8% is a level that is something to keep an eye on for the future if we see any further or sharper pullback. Now, on this uptrend here, we can also identify, I think, a pretty good channel, right? I believe there may be a pretty, oops, not the best. Hang on, let me see if it's a channel or more of a, I believe it's more of a, yeah, no, there was a pretty strong bullish channel, right? There was a pretty strong bullish channel, right? But then you see gold prices actually breaking above the bullish channel and climbing higher. So of course, this channel is no longer valid, but I would highlight this ascending trend line, right? There's a pretty strong ascending trend line that I would like to highlight. There we go, beginning from 6th of Jan, very strong ascending trend line. Now with prices pulling back, right, we see a sharp reversal. And what this support at 2,867 tells us is also, right, if you've shorted gold, for perhaps if you today, if you decide if you had shorted gold, right, where I would identify a take profit target for the short trade would be close to the first support. Right, first support is at around $2,867 per ounce. So for any short traders out there, right, a suitable take profit target can be identified close to this region. And at the same time, perhaps over the next couple of days, should we see gold prices stabilize around the first support and the 33.6% retracement, this is where we have a potential opportunity to go long on gold once more. Right? Especially if this ascending trend line manages to stay remain intact, right? Remember, this ascending trend line is key to the analysis, right? If this trend line remains intact, and prices can stabilize at around the 23.6% retracement, it gives us a good opportunity to go long on gold once more. All right, okay. Right. There's also a request for Bitcoin. Yep, I think we should have time to do Bitcoin as well, right? We'll cover that in a bit. But let's just quickly go to the 4-hour time frame and adjust the pullback. Right, pullback is here, 23.6% Fibonacci retracement. And right, we can see prices are pulling back quite sharply. Right, so for any short traders for gold today, right, I would identify a take profit target at around 2,800 and $75 per ounce, right? At around the first support, right? At 2,875, around that region, suitable area to identify a take profit target for any short trades. And conversely, if we see gold prices stabilize above this region, right? We have the ascending trend line, we have the green Ichimoku cloud, we have the pullback level at 2,872, we have the Fibonacci retracement at 23.6%, all highlighting a potential strong support zone. And of course, if prices can stabilize here once more, it gives us a better opportunity to go long on gold once more. All right, now let's wrap things up by looking at Bitcoin, right? Starting on the daily, of course. And before I continue, I'm just going to launch a poll as well. Uh, for those of you who are on Zoom, truly appreciate it if you guys can give your feedback with regards to today's webinar, and then we'll continue the analysis on Bitcoin. All right, great to see all the responses coming in, right? I'll just leave it running for a little bit longer. Right, okay, great. That's I think almost all of you who have voted on Zoom. All right, truly appreciate it. Just keep it running for a little bit longer before I close the poll. All right, great. All right, truly appreciate it. All right, okay, so let's wrap things up by looking at Bitcoin, right? Let's establish the key support and resistances. I think resistance is pretty clear, right? The all-time high here, right? The first swing high took place in mid-December. Now the prior all-time high took place in mid-December, and then the latest all-time high took place following Trump's inauguration, right? With Bitcoin hitting the intraday all-time high at $109,356. So first resistance is here, a multi-swing high resistance at 107,822. And we also see Bitcoin stabilizing since last Wednesday at around 95,000, right? This can be maybe identified as an intermediate support for now. Where I really see a strong support for Bitcoin is at this overlap level here at 91,800. This is a really significant overlap, right? We can see resistance here in mid-November, followed by support from 27th of November all the way till 3rd of February. So very significant overlap support here. This level at 96,186 is more of an intermediate support, which looks to have functioned as nice as a floor for Bitcoin over the weekend, right? And perhaps we have an opportunity to go long, right? Especially if we see this descending trend line uh, get taken out. So take note, right? Bitcoin has been trading underneath this descending trend line since beginning of February. So any clean break above this descending trend line is likely to see more bidders come in, and we could potentially see a nice run for Bitcoin. So take note for now, prices have stabilized at around 96,000. It looks to be edging a little bit higher, but so far, since 30th of Jan, Bitcoin has been constrained under this descending trend line. If we see a nice clean break above this, it's very likely we should see the bullish momentum gain for the traction, and we could see this currency pair rise up strongly. Sorry, this Bitcoin rise up strongly. So strong resistance barrier here as well, and because of a nice downtrend taking place from 20th of Jan, we can also run a Fibonacci retracement from the intraday all-time high, 20th of Jan, down to the swing low on 3rd. Once again, we're going to be looking at the 50 and 61% retracement levels. Right, this is also a zone to keep an eye out for. Right, so although to see further bullish momentum, right? I would like to see Bitcoin break through the descending trend line, right? That's the first key barrier for Bitcoin. If it can make a clean break above the descending trend line, probably going to see more bidders come in. And then the next barrier is going to be identified by this zone between the 50 and 61.8% retracement, right? And first major support is here at 91,800. Now, can I run a Fibonacci retracement? Okay, actually, I can run a retracement on this uptrend beginning from 13th of Jan, going up to the intraday all-time high. And we can actually see that Bitcoin has stabilized at around the 61.8% retracement over the weekend, right? Or last week. Of course, we can see this wick here on 2 Mondays ago, dropping beyond the 61.8% retracement, but generally prices did recover and it looks to have found a nice floor at around 96,000. Is the right structure bearish? Okay, but now, right, it is in a bearish downtrend. In fact, right, actually, it is probably trading. If you look at Bitcoin, right, it is probably not the best bearish channel, but it is trading what I see within a bearish channel, right? So that is why I said a clean break above this descending trend line is likely to trigger for the upside for Bitcoin. However, if it fails at this uh, descending trend line and fails below the 50% retracement, it can also identify a potential short opportunity for the downtrend to resume. So for now, right, it's Bitcoin is actually trading within this bearish channel that's been in place since 20th of Jan. So if it does stall or fail at the descending trend line and fail at around a 50% retracement, we could see a nice bearish reversal opportunity. But on the flip side, if you see a big clean break through the descending trend line, that's going to attract more bidders, and we could potentially see Bitcoin climb higher, probably make a good run towards 104 or 105,000. All right, okay. So that's all I've got for you guys today, right? Right. Thanks everyone for tuning in to today's session brought to you by Vantage, right? If there are no further questions, then we'll call this a wrap, right? And do look out for all upcoming webinars brought to you by Vantage. And I look forward to seeing all of you at the next session. It is also a question about price fails to make new highs. Is it mean bearish? Right. Okay. Just because price fails to make a new high doesn't mean it's bearish, right? It's also due to identifying the chart patterns and also looking at momentum indicators such as the Ichimoku cloud as well. So do not think that a failure to reach the previous all-time high means that it's a bearish outcome, right? There are a lot of other factors that you need to consider, right? You would need to look at momentum indicators such as the Ichimoku cloud. You would also need to identify chart patterns, right? We can see that even if right now we see it trading within this bearish channel, indicating the current bearish momentum. However, if it breaks out of this level here, right, and rises higher, we have strong bullish momentum, right? But if price fails to reach the prior all-time high, it doesn't mean that it's bearish, right? It just means this segment here, should we see the bearish bullish breakout take place, we are likely to see strong bullish momentum. And even if price fails short of the uh, intraday all-time high, it doesn't mean it's bearish. We're actually looking for structure. We're actually looking for price structure. Like, for example, a good example of structure is here, right? We see a very strong bullish channel, right? We see a very strong bullish channel, which finally gets broken in the third week of December. So when you see price structure give way, right? When you see price structure give way, such as this is where I would say, yes, the bullish uptrend has ended, when we're likely to see a period of neutral, sideways action, or perhaps even bearish momentum, right? So look for significant market structures to be broken, right? To determine whether we are in a bullish or bearish environment, look at momentum indicators such as the Ichimoku cloud, which helps us indicate the correct direction. And yeah, that's I would say, right? Don't just look at one single point where you say price fails to make a new all-time high and then it's bearish, right? There's a lot of other factors that you will need to consider as well. All right. So that's all I've got for you guys today. Thanks once again to tuning in to today's session, and I look forward to seeing all of you at the next one. All right. Thanks, everyone. Take care and have a great trading week.